what are we seeing now on, I know CPI is a number that can be messed with in a lot of different ways, but why don't you talk about what that basket of goods looks like in terms of the allocations, if you know them, and then what are we seeing in terms of pricing, where that's tracking, and what that's saying about the future of inflation.
Yes. So one thing I'll say right off the bat is I'll read off a quote from the Bank of England. Now we obviously know that when it comes to the United States, we are the beneficiary of the most liquid, sort of the most liquid and actively used currency around the world. So when we debase, it impacts us less than it does our counterparts globally, who actually have to debase more on a relative basis in order to make sure that their currency doesn't strengthen too much relative to the dollar. When we weaken our currency, everyone else has to as well, to a much larger degree. And that has led to much higher price inflation, of course, over there across the pond. In the Bank of England, they're fighting 10.4% inflation, and it's still up there where we've been able to reel it back in. We're now at 6% inflation, still absurd, and still very undercalculated. The UK is battling 10.4% inflation. In the Bank of England, one of their speakers, Tenreiro, I do not know their first name, Silvana Tenreiro, they said that they see rates falling to keep inflation on track. Wait a minute. What was that, Silvana? Can you repeat that? Yes, she said, we see rates falling to keep inflation on track. That's interesting. She said that she sees an earlier and faster reversal of recent hikes to keep inflation from falling well below target. Wait a minute. The veil just came off, right? This idea of inflation targeting from central banks. This is what central banks do. They create a problem and then they work to destroy the problem. And in doing so, they create mass this mass tumult and this mass turmoil for real people, this mass misery. They create the inflation problem, which is an unfortunate byproduct of the system that we live under, right? That is incumbent on credit growth and credit creation for real economic growth. They create the problem by keeping rates locked at zero, expanding their balance sheet, and really incentivizing this credit creation. Then when it gets out of control, they do the exact opposite. They aggressively restrict access to new credit. They aggressively remove money in the ways that they can from the real economy. Then that creates mass unemployment. And then they come back and they do the inverse all over again. And so really they're creating problems and then solving them. And the veil really came off, right? They're contending with 10.4% inflation, but the UK tightened so fast that now it's worried about deflation and is considering rate cuts to prevent that. So I mentioned amplitude. The amplitude of these moves in interest rates when we're talking about US Treasuries is staggering. It's never happened before. Intraday Treasuries don't just swing half a percentage point regularly for several weeks in a row. That just doesn't happen. Now, the same thing is true of every other component of the economic cycle. These cycles are growing wider and more pronounced in their amplitude, in their wild swings upward in expansion, and their wild swings downward in contraction. And central banks have no idea what to do. Inflation is 10.4%, and they're talking about making sure they cut rates so that it doesn't fall below their 2% inflation target. That's insanity, right? When it comes to the CPI basket here in the United States, though, a couple leading indicators we can use to sort of gauge what that's going to do. We talked about commodity prices; those are useful, right? Crude oil, the price for crude can sort of be thought of, and this as a derivative for the price of other things, the price of food, the price of other goods and services, because broadly, not only is it an input to a lot of those things, as is the case with copper, but also it is sort of a proxy for demand, right? If this demand for the most widely used energy globally is falling in the form of its price falling, and even the supply constraints, but its price is still staying stagnant, that shows you demand is being destroyed. And so for that's one leading indicator we can use here in the US to say that inflation probably won't be sticky per se, as many pundits have said. I tend to disagree with that because of the oil thing. But also, if you take a look at prices paid, which is a component of both the ISM manufacturing survey and the ISM services survey, on both fronts, that is contracting, and it's contracting very quickly. Excuse me. In this most recent survey, it fell from, and this is an oscillator. It oscillates around the 50 level. Above 50 is expansion. Below 50 is contraction. Basically, that's just whether more or less survey respondents said that prices are more expensive or less expensive than last month. And so that metric fell from 65.6 to 59.5, right? So it's a pretty steep fall But also, if you take a look at what leads prices paid is new orders, and new orders fell from 62.6 to 52.2. And so people are getting much, much, much less orders. Not only are they making far fewer orders in their businesses, but they are receiving far fewer orders. And what naturally comes after that, it's lower and lower and lower prices to try to stimulate demand from these businesses. And so asset prices are falling right on the manufacturing front, and also on the services front, prices are falling as well. And so I have no doubt that the CPI basket will soon follow and we'll continue to see disinflation. The question is, how quickly will that disinflation come? I think there's more of there's more of a right tail risk chance that we get faster disinflation than a left tail risk chance of disinflation being sticky, I feel. And that's just a byproduct sort of downstream of everything that I've talked about in this discussion today, which is that this cycle is contracting much faster than previous cycles have. It's breaking all precedents from a volatility standpoint, not just on the inflation front, but also on the behavior of the bond market in response to what the prevailing monetary authority is doing. And so I tend to think that because of how fragile, how fickle this cycle is contracting and deterioration is occurring so swiftly, I tend to think that the same will be the case for price inflation. And the Fed may have to make the choice to pause here and potentially cut sooner than it would like to. Cuts are not my base case for at least a very long while, right? It has the chance, it has the ability to maintain financial stability through these facilities that it props up, as well as its balance sheet tools, while keeping rates elevated to try and contract credit. But the question is that credit contraction so severe that CPI reaches its 2% target much sooner than anticipated, and it really threatens deflation, which is terrible for economic growth. So that's the question. I think that will begin coming to people's minds like 6 months from now. I think the question for the next 3 to 9 months, it's basically right at our doorstep, is how severe will this contraction be? And I tend to think, more and more each day as these really startling data points come out, I tend to think it will be more severe than most expect.